Right. Hello, everyone. I'm sure you have some lunch, or if you don't have lunch, you might wait for another hour, so feel free to grab some lunch here. I heard it's good. Look, today we have a panel about financial market and blockchain, probably not an immediate topic that a lot of you would think of when you put blockchain and financial market together. But I think in here we have a very diverse, balanced group of I would say industry leaders that have looked at this space for some time. Between VC and operating company, as well as asset management company. And also we have DeFi, CeFi combinations as well. So I'll start first with introducing myself, and then we'll pass on to the rest of the panelists. So my name is Quinn. I lead investment for GSR. GSR, if you search online, it probably be well known as one of the largest market makers, trading firm in the crypto space. We have about 250 people globally, London, Singapore, Switzerland, Spain, as well as the US. I've been spent about 10 years in investment banking before, done about $12 billion worth of transactions in M&A, and then moved on to the world of crypto back in 17, where Bitcoin was about 20,000. And that was pretty exciting, but I wasn't there for the Bitcoin. I was there because a lot of companies in this space actually not only attracted the best talent, but also doing something innovative for the financial market that I was working in. And that's the topic that we're going to explore today. Just a little bit about GSR on the investment side. Besides being a trading firm, we're also an active VC fund. We have invested about $100 million of our balance sheet into the space, mostly in the pre-seed and seed round, which we can talk a little bit more when we come to the investment thesis a bit later on. But I'll pass on to Anatoly to introduce himself and the rest of the panel.
Hello, everyone. My name is Anatoly. I'm CEO and co-founder of quant hedge fund, London-based Nickel Digital. We are a multi-manager fund managing different market-neutral strategies comprising start ARB, relative value, future basis, different flavors of arbitrage, fully crypto-focused. We are regulated both in the UK by FCA and CFTC in the US. My prior background, I was in banking for a good 25 years, most recently with JP Morgan and Goldman, and left kind of traditional finance 4 years ago to co-found Nickel on the understanding the whole crypto ecosystem is a new emerging asset class. And we embarked on this journey to build an institutional grade access to this market. We'll discuss it later, I guess, but we took a view of not taking a directional exposure to the market, but rather provide access to a market-neutral strategy. Thank you.
Hello, everyone. My name is André Rabetanetti. I am the Chief Operating Officer of 1inch Network. 1inch Network is a decentralized finance service provider with an aggregated transaction volume of about $350 billion since inception. We are empowering millions of users doing swaps, storing and sending tokens through our 1inch wallet. We recently have released a new functionality called 1inch Fusion that is enabling a new style of swaps. My background is also in traditional finance. Before joining 1inch, I was working in the fund management industry in financial modeling and valuation. Pleasure to be here to discuss financial markets.
All right. Hey, everyone. My name is David. I run OP Crypto, which is an early-stage cross-border pre-seed and seed venture capital fund. We also have our own dedicated crypto-native fund of funds, so running 2 vehicles at the moment. Started this about 2 years ago with the notion that we really help some of the best entrepreneurs in the Western market go to market in Asia. And thus, we have offices in New York, San Francisco, Beijing, and Hong Kong. So prior to starting OP Crypto, I was leading global strategy and investments at Huobi, which is one of the larger exchanges based out of China for 4 years.
Hello, everyone. Marcelo. I'm one of the partners of Tagus Capital. We started 2 years ago investing on the crypto space. We starting early stage companies all the way to Series A. We're very excited with the space. Some of our partners live in the Oxford area, and we are very proud sponsors and be part of the Oxford, ecosystem. So we're looking forward to carry on contributing to the development of a blockchain space here in Oxford, and we're real believers.
Great. So now we hear all the background of the panelists on the call, in the panel today. So look, blockchain, there's a lot of things that are happening right now, right? In the last 2 years probably has been more about the price of cryptocurrency. But here today we explore a different topic, which is how the world of financial services and blockchain going to converge, and how they're going to be helpful to the rest of the ecosystem, not just the one that holding the token. So we can agree that blockchain has a potential to transform everything from payment to digital banking to financial to loan. And there are some really prominent CEOs who have came out and said, maybe it's just a bubble. It's a tulip, recessions, or it should be killed by itself tomorrow. It should self-implode. But obviously, we are still here today, and the question is asked is that how should these financial services company, the existing one, the TradFi world, should be afraid that blockchain is coming to replace, help, or accelerate the development of the crypto world? And so I would ask the first question is, what do you think are the key use cases, the financial applications that the digital asset world can help the traditional finance space? And I would probably direct this to Marcelo and Anatoly, who probably spent a significant number of years in the TradFi space, and come from that perspective first.
Sure. So I'll start. So I should have mentioned that before getting into crypto, I was 20 years in financial markets, a bit similar to Anatoly. So first of all, the financial system as we have it nowadays was built in the 70s. All the piping, all the network of payment settlements was done on the 70s. Okay, so we still have nowadays things like equities and settling in 3 days' time. You have bonds that take 2 days' time to settle. You have FX transactions that take 2 days to settle. And clearly, in the 21st century, you wonder, okay, is there a better solution for that? Clearly there is. Blockchain can do this instantly, but it is not just that. It's the arrival of smart contracts. I think it's a huge use case, because in finance you have always the figure of this trusted third party, which in the end of the day is like a rent seeker, which is the banks, which they are. When you do a transaction, you have to post your money in a bank to then get your service delivered. With blockchain and smart contracts, you no longer need that figure of this trusted third party. It's still nowadays in London, if you want to buy a house, you need to deposit your money on a escrow account of a lawyer, and then once the money is there, then the transaction can go forward. So, clearly there's so many immediate use cases that blockchain is changing and will change in the near future, that, the use cases are enormous. So we are very, very optimistic about it.
From my perspective, from my perspective, tokenization certainly is a massive wave which is coming from traditional finance. And Larry Fink, CEO of BlackRock, recently has stated this is the next wave of innovation. And fundamentally, there is no reason why traditional assets, including fixed income equities, should not be blockchain-based as the asset. Why would that be beneficial to the society? First of all, you're accessing immediately immense liquidity pool. Your trading is not limited to the New York Stock Exchange working hours, which is 7 hours a day, 5 days a week, but rather it goes 24/7. So from the issuer's perspective, the liquidity of your instrument is much greater because it's a global liquidity pool. So the pricing is more efficient, and there is the whole slew of additional benefits, including lack of intermediation, because certainly some services are going to be out-mediated, but that's fundamentally for the benefit of the underlying investors. So this certainly is, tokenization is coming. On the primary issuance, we had few, not attempts, it was kind of test runs done by a few institutions, including Goldman, actually 2 years ago, issued a first bond for European Investment Bank. And very few people know that actually it has been exactly 2 years since bond was issued. It was 2 years bond and fully settled. So we had a full life cycle of a bond, which wasn't a digital twin of a traditional bond, but actually fully blockchain-based. Now you have UBS with their own tokenized platform. You have HSBC with their respective platform. And every major institution is working on these tokenization platforms. When it's going to come, I think it's a matter of time. There is one big elephant in the room being regulation. And of course, regulatory framework must be there for all large institutions to engage. And also there is some element of mistrust and user interface, which unfortunately suffers in crypto. We're aware of that, and there is the whole range of companies who are building these interfaces. At some stage, the floodgate going to get open.
No, I think I agree with the two use cases of optimization in the settlement and issuance of a market. I think speaking from the TradFi perspective, I think one thing that can also be a benefit from the TradFi perspective and the consumer perspective is financial inclusion. I know this has been thrown as one of the key themes for decentralized finance, but what we also observe is that in countries where the access to traditional banking system is pretty difficult or low, that's where also you would see a more convergence between DeFi and TradFi, DeFi being, or crypto being an alternative to the financial system by also streamlining a lot of the functionalities that a bank would otherwise do.
Yeah, I think from like just a consumer perspective, sending money should just, or any type of monetary value should be as easy as sending a text, right? So like, if I wanted to airdrop each and every one of you guys just some money for attending the conference, like it's very difficult to do that right now in the current financial structure. So I think going forward, like having a literally like a hot wallet for each and every person in the world, as easy as they're able to spin up a bank account here in the UK, like should just be a very simple process for everyone involved. And being able to just send and receive money to anyone in the world should also be as easy as that, right? So I think we're really building the infrastructure to be able to allow every individual to be able to do that. And, you know, in fact, like when I was living in China for the past 10 years, like that's very easily doable now, like within the China market, but it hasn't gone global. And blockchain technology and the infrastructure it provides is the way it allows things to be on-chain and to be able to really address the global market, whether they're emerging markets or developed markets.
Yeah, and by the way, the issue of underbanked population is critical, right? It's easy to sit here in London or Oxford and every single person in this room has a bank account. But once you move to the less wealthy countries, that's not a common. It's 1 billion people who are still underbanked. And the reason traditional financial system cannot provide this access because there is really a cost of maintenance and account opening. And unless you have at least $200, $300 in your account, from the bank's perspective, they can't wait for you to shut down your account. So from that perspective, we have to leapfrog in a more modern technology being blockchain, which opens much wider access to banking services or kind of blockchain-based services. And another important element of the whole crypto ecosystem is credible neutrality, because what we are facing in traditional financial system, you are unfortunately relying on a centralized agent to maintain a system, right? Being it US dollar or any other currency. It doesn't have to be like that, because unfortunately, once you have centralized agent, you become hostage of you being in compliance with their political views or any economic considerations. So blockchain essentially eliminates this unnecessary keeps dropping. This unnecessary counterparty risk with a centralized agent.
So that was an interesting few, point that we touched on, right? You got about the settlement cycle, the unbanked market, and then also the tokenization part. I just want to leave you with some number on why I think this market is going to be very important for blockchain to tackle. Today, the blockchain crypto market is about $1 trillion, right? Or plus minus, depending on the day. Sometimes get to 2 trillion. But if you look at, the bond market, that's about 300 trillion of the private debt market at real estate, and then the private debt market is about 250 trillion. So if you be able to just tackle some of that market, put it on-chain, you expanding the ability for this technology as well as removing the middleman in middle. So you can take out hundreds of billions worth in terms of just fees that these banks that are copying in the middle. And just another number as well is that between the 4 biggest custodian bank out there, they hold about $12 trillion worth of assets, just clipping fee being in the middle. And so you can see the tremendous potential that we want to see the financial services company, or at least company in the blockchain space, can tackle this and expanding the TAM for crypto much more beyond the 1 trillion that we traded today. I guess we talk a lot about the potential, but in reality is why is only $1 trillion, right? We have to tackle that question. So in your opinion, and here, what are the main challenges for people to adopt this, right? We could come from many angles, institution versus retail, DeFi versus CeFi. And I would like to first go with the angle of DeFi with Andre. How you think that, what is the biggest challenge on the DeFi acceptance for institution and retail?
I think there are many challenges. The main one is around user experience and education. So one of the downside of the blockchain technology is that it's complicated. I mean, one thing the traditional finance sector is doing well is to hide complexity. You have someone that is basically blocking any problem, saying, trust me, this is going to work. The trade is going to settle. You have to trust the middle person because I take the responsibility for delivering this. In blockchain, you have to learn about smart contracts, how transactions are done, how transaction goes to a mempool that could be potentially facing some maximal extractable value. So there's a lot of things that is scary and that people needs to be educated on before they touch on blockchain technology. So education is very key, and also simplifying as much as possible all the concepts and the user experience is going to be very critical.
So you got to talk about the UI, UX, and the understanding, right, from the retail side. Do you want to add from a perspective of institution? So from retail it's hard to understand, but institution, surely you got people that will be smart enough to understand the technology. And what is the challenges for them to actually go and try to use like one inch or other to participate in that market?
Yeah, so for institution, that's a different type of things, and we are facing this because we are right now working on a product called 1inch Pro, which is designed for institutional investors. And the feedback that we are getting is that there should be a minimal requirement for compliance that needs to be implemented for them to start playing into that field. So it doesn't have to be meeting exactly all the regulatory constraints that banks or funds have, but there is a minimum level of regulatory compliance that needs to be implemented, such as AML, KYC, and what we found in our 1inch Pro project is that the solution will be around self-regulation, self-regulatory practices. So we recently this year have obtained a membership to SRO, which is a self-regulation organization, where this is, at least according to us, the best way to get started, which is trying to implement tools to do compliance, but do that ourselves and then send those reports to the regulator. That's really the key issues right now. The key barriers of entry for those institutions is to find a way for them to have the compliance layer that they need to bring on their own end users.
And is there anyone to add to the DeFi perspective before we move on to CeFi?
So we are institutional-only hedge fund, and because of that, my conversations are primarily with different allocators, starting with pension funds, university endowments, banks, fund of funds. And the biggest concern, which I'm hearing again and again, is, of course, KYC angle in DeFi. From their perspective, given that they are regulated, they have to ensure that every single dollar which flows through the system or dollar which they engage through us has a clear counterparty. So I think we have to solve the issue of KYC IML, because kind of open space will not work with institutional investors. They are on the hook from the respective regulators. So unless this angle is brought to solution, we're going to be in this limbo for a while.
Yes, so there were 2 points. One, he has already addressed, which is the regulatory bit that needs to be addressed by the regulators. European regulators are by far the ones further down the line. With MiCA, we're going to be ready next year. UK is catching up very quickly. The US, as we know, is way behind. So that was required for institutional adoption. Now, on the retail side, again, crypto is a journey. I think the main issue for adoption on the retail side is that it is, as Andre has briefly mentioned, is still too complex for the average user to deal with crypto. So I'll give you a simple example. I like to make the example of the iterative broker account or your Robinhood account. You can trade bonds, FX, commodities, and you don't need to know how a wallet works or, like your private keys or your ledger. All this complexity is hidden behind because the cost of transaction is very low, right? So, but because gas fee until very recently was very high in crypto, it's very difficult for you to make a product that you can hide away this cost behind like a super app for clients. Now, crypto is moving towards that. With the arrival of the layer 2s, transactions became much cheaper. And very soon, in a not distant future, you can see a super app where you're not going to require the complexity of clients understanding what is a gas fee and that you need for transact and so on. And that's for the average user, together with regulation, for the average user, this is going to be, I think, in my view, what's going to get them into crypto, because they don't care how much is the gas fee, if they're transacting on Ethereum, Solana, Near. They want to trade crypto, know the price, the quantity, as long as it's quick and easy to understand. That's all that matters. So for this simplification to happen, the gas fees need to go down, and the layer 2s are part of the solution of that. So I think we're going towards that. Adoption is going to increase together with the regulatory framework that is being built right now. So I think next 2 years, we're going to be a significant increase in adoption.
Yeah, and I think the final point is really like the composability and the acceptance of crypto into the mainstream financial infrastructure as a way of payment, right? Like right now, you can't really pay anything with crypto, right? So like eventually, I think it reminds me of the early internet days where it's very hard for you to do any online transactions, if at all, right? Until things like PayPal or like Venmo came around, where you're able to sort of pay for things via your own very simplified sort of account ledger. So right now, everyone kind of uses crypto in a very crypto native way, whether it's within sort of the DeFi markets, whether it's within NFTs, like everything is very composable, interoperable within crypto right now, right? I think there needs to be ultimately a bridge that allows people to convert their crypto into tangible payment facilitators that allows them to buy real goods and real products. And a lot of this is being changed in the more emerging markets like El Salvador, Venezuela, where a lot of these countries are coming out and using Bitcoin as a legal tender. And a lot of sort of Southeast Asian countries use USDT Tether as sort of just dollars in that they're able to transact in the day-to-day items as well. So I think people are getting used to the notion of holding a crypto wallet and then using that as a storage of value. And then whenever they sort of need fiat to cash out, they will cash it out into fiat. And that experience itself is getting easier and easier. And it only takes time to really get the user experience that we need for mainstream adoption. And remember, sort of the e-payment space really took like 20 plus years for that to develop in the way that we're able to use it today. So gotta stay patient.
Yeah. So obviously UI UX still today pretty junky, right? Very difficult to use. Even the people in this industry, we still have sometimes struggled to use some of the applications, and hopefully that is a matter of solving by time, by education, as well as clearer regulations that allow consumers to actually understand what they're getting into. New technologies such as you mentioned, like account abstraction, as well as privacy. Is also pretty important because we don't know who behind all of these applications as well. And so from an institutional perspective, and probably a little bit on retail as well, probably in 2022, most of if I was just an ordinary consumer and I read the news and saying, Terra Luna collapse, one of the biggest exchange collapse, people losing 10, 20 billion, and then another company collapse. So what is the trust that I have for this system? What is the trust that an institutional, from a TradFi perspective, have for the system as well as retail? So what do you think that is the key problems that are going on here in terms of counterparty risk, and how do you think institutions and retail is going to be able to tackle this and trust to use whatever application that these very talented entrepreneurs are going to build?
So, counterparty risk, which you mentioned, right? It's not a crypto-specific problem. As a matter of fact, crypto is designed being a decentralized asset to eliminate counterparty risk. What we saw last year with multiple collapses, we witnessed collapses of centralized entities. And FTX was a clear case when one entity, being a matching engine and exchange, was also carrying other functions, such as custodying client assets and settling, which is not a typical function in a traditional space. So if you trade on NASDAQ, your assets are never with NASDAQ. It would be held by one of the major custodians, being State Street, BNY Mellon, or JP Morgan, but it never touches the exchange. Exchange would would match different transactions, and then settlement would be carried somewhere on the side. Now, in crypto, unfortunately, we developed in a way when exchange was handling all these functions, partly because 10 years ago there was no independent custodian. This has changed dramatically, and essentially FTX triggered an industry-wide reassessment of counterparty risk and remodeling of the existing structure. What I mean by that? There is a notion of exchange settlement, whereby, similarly to traditional finance, assets are kept by an independent custodian. And then exchange accepts, say in our case, if we want to trade on, say, OKX, my 50 million would not be sent to OKX as a margin, but instead it would be deposited with our custodian. And then OKX would accept that 50 million locked in their favor, and they would allow me to trade within this margin. What we are trying to achieve to eliminate this unwanted counterparty risk with a given exchange. If exchange goes bust, so be it. We never had capital with that exchange. There is residual risk of unsettled P&L. If I'm on the right side of the trade and I made $1 million on a trade and exchange goes bust, then it goes bust with my $1 million. The way you address that, you bring settlement cycle not from once a month or once a day. You bring it down to every 4 hours with the ability actually to enforce and create minute-by-minute settlement. So at the time of distress, I have this option. Essentially what happens is that my event horizon with a given exchange is 1 minute. As long as they survive next minute, I'm going to be perfectly fine. My capital was never there, and P&L is perfectly settled. So basically, in the pre-FTX world, this concept already existed. The balance of power was in favor of the exchanges, who would push back, saying like, hey guys, you're coming up with these very complex off-exchange structures. Nobody needs that. We've been in business for the last 5 years, and nothing has happened. And to some extent, we just couldn't force this change. In a post-FTX world, the balance of power has shifted, and people like us who are trading meaningful amounts, we're trading roughly $80 billion annualized. So that basically we have now a say saying like, unless you guys move to off-exchange settlement, we're withdrawing our trading completely. And what you saw in the last 6 months, Copper, for example, who is one of these providers of off-exchange settlement, was completely overwhelmed by the workload of all the exchanges moving to off-exchange. And what it meant that, for example, in our trading, we moved from off-exchange being only 5% 6 months ago to off-exchange being now 95%. Pretty much your entire trading goes kind of in a model which eliminates counterparty risk. And in this particular case, we are replicating good practices from traditional finance, but they are for the benefit of the whole crypto ecosystem, because you have to segregate these functions, and finally we have arrived there.
I think the answer to the question could be reformulated as, how do you create trust in a trustless environment? And the way crypto has usually done this is by transparency, so bringing transparency on the applications that are actually built, and by having this transparency, use auditors and a community to actually challenge whether whatever is going to be built is to be trusted. I mean, you have various examples of this. For example, in France, you had Société Générale who developed, I think, a stable coin, and you had a lot of back and forth on the codes that they have actually created. They created a sort of a backdoor that enabled them to actually implement some of the requirements from the regulator, which is if there is an issue, they can block the fund or seize the fund. And that's actually how people can say, hey, you can also use that backdoor function to do something else. So I think a lot of the trust will come, again, from being more transparent on what is being built, and also on having engagement with the community of auditors to bring the trust to multiple, to the community. But there will be, if that doesn't work, if transparency could be also, I think, a challenge for the institutions, I think the tendency is to go back to a centralized approach where the trust is going to be, it could be done by somebody else. And that's also what we see, for example, in BlackRock's ETF application, where they have some sort of another system that someone else is going to check what they're doing. So I think that's typically what is being implemented.
Yeah, and also I think one thing to understand about blockchain and the public ledger is that now you can actually trust the money itself, right? Like previously when we're dealing with cash or a lot of sort of the online digital payments, you don't actually know where your money is going, right? From point A, you made it from point A to point B, but from point B to elsewhere, it's very hard to track. Now with sort of cryptocurrency as itself, right? Everything is programmable, everything is, you're able to see on the ledger exactly where it's going from point A to point B and where your money actually flows through the process with on-chain analytics, right? So it's just how do you prove that something is organic, or how do you make sure that a document gets from the right places at right times? I think now you're able to on-chain and verifiably be able to trace wherever your money goes and how that money is being put to use, right? So I think this is extremely important when it comes to nation states or charities or anything that ultimately is doing good with the money itself, and it's not being really funneled and done something illegal or done something improper in the back end. Now in a sort of decentralized format, we're able to clearly see how sort of that money processing and facilitation is being done on the back end, where previously for centralized entities, it's very clearly a black box where it just on sole discretion of like the managers themselves, rather than like really available to the public to even vote and dissect like what should be done with that money itself. Right?
I'll just make a small comment to complement that. We have 10 minutes to go. Should open maybe to Q&A after that. The trust element is not even required with smart contracts, right? So if you think about, we started talking about, oh, Luna, went under, and then you have all these centralized exchanges that they have the same problems that banks have, which is like, trust me, I'm taking care of your money. If I'm lending money on Aave, I know that the guy that is borrowing, if he over-leverage himself, he's gonna get liquidated no matter what. So I don't need to trust anyone that this is happening, because it will happen. And you could see as Celsius, FTX, and many others went under, the huge worry that these companies had is that they had no one to negotiate on the other side when they were talking to Aave, because they knew that if they didn't post more collateral there, they were going to get liquidated. There was nobody to talk to and try to wiggle yourself out or say, hey, can I get better terms on my borrowing? No, you're gonna get liquidated. So with smart contracts, you can completely remove this trust element. And I'm a firm believer of DeFi, and I think medium term, as we get regulations in line, the space for growth is enormous.
Yeah, so we obviously touched on a lot of different challenges there that for this space, but obviously challenges mean that they are opportunity and potential, right? And so counterparty risk is obviously a big part that we have mentioned. And so with this in mind, obviously we have seen in the past few years for the potential entrepreneurs that are going to gather from Oxford, there's about probably $50 billion so far have been raised from about 6,000 crypto company in the past 6-7 years. And there's about another $50 billion of dry capital that venture capital firms are sitting on. And I'm pretty sure that of us and all the venture investor here also have dry capital to sit on and actually see what are the next best projects to invest in. And so I'd like to probably spend the next 5 minutes on both on the private market and public market. The first one is, what should be the themes that we're looking out for in the next 3 to 5 years or so for the entrepreneur in this room, that what they should be thinking about building to tackle is no problem that we just mentioned just now, or something even more creative that we haven't mentioned for financial system. So I'll probably direct this to David first on the VC side.
Yeah, I mean, I think like everyone asks the question like, what do you think the ChatGPT moment for crypto is, right? And I think like one of the most universally adopted products that people buy when they're younger is like a piggy bank, right? Like almost everyone in some time in their lives, they actually spend physical dollars to buy something that like holds money for them, right? So I think with sort of the invention of blockchain technology, now everything's trustless and there's no longer this like large overbearing cost to hold and custody monetary assets for you, right? So going forward, I think this concept of like a neobank for the universal masses, anyone with the internet to be able to have a mobile wallet and be able to store crypto and have a lot of derivative products within the market that allows them to invest, reinvest their money, to allow them to send it to their peers and also allow them to really be able to spend as they see fit. It's like one of probably the best universally adopted applications that crypto and blockchain technology can be able to provide, right? So I think a lot of us as private market investors, we're investing in sort of infrastructure rails that allow people to really, do all sorts of activities on chain, right? And this moves us to a very much more digital native world in that not only are they able to, play games, have NFTs, but also be able to spend and invest their money wisely on chain without sort of having to deal with a lot of these centralized entities of the past that we've all seen have big financial collapses. And I think even a financial market collapse would probably really unravel sort of a lot of the blessings of crypto. And maybe it does take some of these cataclysmic events for really crypto to come mainstream, because people should feel much safer putting their money on chain rather than with a centralized entity or a bank. And a lot of the banks, even within sort of the most developed markets like the United States, a lot of the regional banks are failing. People no longer trust their money there, and this is a big issue going forward, right?
Yeah. Marcelo?
Yeah, I think you touch on a key point, which is like, again, we always go back to trust, right? When you're using the dollar, you are putting some trust in the person behind the printing machine that they're not going to print too much, that your asset that is held in dollars is going to lose value. And what the last 5-10 years has shown us that, you know, the guy controlling the printing machine is losing control of the printing machine, basically. And instead of defaulting, they are defaulting by devaluing their currencies. So crypto is part of the solution for that, you know, you don't need a trust party, someone that controls the printing machine to hold your assets or keep the value of your savings. And that's very important. Of course, part of this big pushback you see in the US is because, you know, according to the BIS, 88% of the international transactions, they're still being done in dollars. So why would someone that has a monopoly of the currency, why would they open space for other means of payment or storage of value, particularly when the system is very fragile and brittle, where with the regional banks going under, they need to keep that liquidity into that system. Why would they open space for other means of payments or storage of value? Of course, they have no incentive for that. And that's what we're seeing right now, right? You're seeing Europe and Asia taking the lead, and the US eventually will have to come along because they are not going to be left behind. But, you know, right now, I think we're seeing a bottom of the current cycle because the US is clearly trying to, this current administration is trying to keep as much as they can of the monopoly of the currency in the market.
From the opportunity perspective, I think there is a massive emerging opportunity in the quant strategies in crypto. And quant certainly is not new, right? They have been used different of these strategies in traditional space since 1970s. However, if you look on the traditional space, the big quant hedge funds, such as Millennium, this is kind of a large pots of capital, like 60 billion and above. And the reason there is such a concentration, because the entry into this market in traditional space is there is a very high bar, and hence the capital is being concentrated across these few large oligopolistic, if you will, players. Now, crypto gives completely different access points. To start with, the information flow from all trading venues is pretty much free, right? You don't have even buy Bloomberg for 25K a year. So basically, your information is free. You can build funds pretty much from the scratch. There is one difficulty, is raising capital. And unfortunately, crypto is still on the verge for many investors, and majority of them would not engage at this stage. And hence, we saw our role in this world is building a multi-manager fund, whereby we're entering in partnership with different quants, moving from traditional space into crypto, or starting their models from scratch, as crypto being their first ever implementation. And essentially, they're contributing in this partnership their models and signals, whilst they retain the IP on these models, whilst we are contributing infrastructure, regulatory approvals, and capital. And from that perspective, we can take young groups of traders and scale them up to 25 million. And that creates the whole range of newly created, if you will, fund managers who retain their independence from us. They retain full ownership of underlying model and the track record, but they are certainly seeded, if you will, by people like us. And to me, this is like the whole enormous opportunity set. And crypto gives you this very rich, alpha-rich environment. Because if you look on the traditional space, again, coming back to NASDAQ, it would trade 7 hours a day, 5 days a week. It's roughly 19% of what crypto trades, which is 24/7, which means digital asset space produce far richer data set, which you can analyze, find patterns, and build ultimately signals out of that. So I think that's the opportunity for us to help people become independent traders by virtue of funneling capital. Of course, it's very, risk here is incredible given the volatility in the underlying space. So you have to impose certain layers of risk management, but it's doable. That's exactly what business we are in risk management of 20 groups of traders trading for us.
Just to conclude it, and then we will open it for Q&A. From a GSR venture investment perspective, we're always looking for the infrastructural projects that you have all mentioned, and as well as anyone that building on real-world asset, the connection, the interjunctions between traditional finance as well as crypto, and whether that is DeFi and CeFi. I'm pretty sure that the panel here is look forward to listen and see the project that you're building. I know that Oxford University have some really great alumni that look out for really interesting project. And so, do we have questions or? Okay, fine. So, any questions, please ask all of us at the backstage, and we're very happy to be here. And I think the one conclusion is that we all believe in crypto, and we believe that it's going to be a great addition, acceleration for the financial market. So thank you for listening.